And so where we had left off yesterday was we started to lay out the Heinz assumptions as per its press release, right? The press release February 13th. And the situation was how to think about, laying out its purchase price and sources and uses given the limited information that we had, right? So they've given us that they were paying $72.50 a share. And then when we found out, we ended up pulling up the proxy report, which we're going to be using today. So let me pull it up again. In the proxy report, we had established the sources and uses of cash. Actually, on the front page, they had given us an indication of exactly how they got to the purchase price, which is very helpful because the first thing we need to do is figure out what the diluted shares outstanding was. So the proxy report showed us how they got to the diluted number of shares, so we backed into that. And it also, which got us to the $23 billion purchase price, and we're going to use that to apply to the sources and uses. So the next question is, well, what are the uses of cash? And part of that question is, what are the fees, and what's the net debt associated with that? And so, unfortunately, even though they had some language talking about the uses of cash, this was a preliminary proxy, so they did not lay out exactly yet what the uses of cash were. So that was kind of a TBD. Right? They say here, this is what the financing the merger is. They anticipate the total funds to be X, literally. They left out blanks. But what helped us was they did tell us how the deal would be funded. So they said that it's going to be, and we laid it out here, it's going to be a combination of $10.5 billion in term facilities, $2 billion in notes, $8 billion that Warren Buffett put in, $4 billion that Warren Buffett put in, and $4 billion that 3G put in. So we're going to use that to determine the uses of cash. Right? Also, what I'm going to send you, what we're going to lay out today is building the core model, building the income statement, building the cash flow statement. Remember what we talked about when we did the mini version of this analysis. Right? These guys are putting in, based on the sources, 3G is putting in $4.1 billion. Warren Buffett's going to match that, but then put in an additional $8 billion, which is a preferred security acting as kind of a debt hybrid. So the question is, what's their interest in it? Right? So we did this high-level analysis, and just to kind of refresh our memory, so we have good direction as to where to go with this. What were I guess in any LBO, what were the three basic paths to profitability? What are the three basic paths to profitability? Good, big private equity, good question. Right? In an LBO, what are the major paths of profitability? Say it again, Marshall. Improve EBITDA multiple expansion. So we didn't do our purchase multiples yet. We will, and the purchase multiple is 14.4. So in the mini analysis, we concluded the multiple is pretty high, right? In a declining industry like consumer products, right? Multiple expansion is probably not likely, right? They might have to sell the business for less unless they really find a way to change the type of business that it is, given that they're merging with craft. It looks like that's the strategy that they're taking, right? Which is another area of growth. Operation improvements, right? So improving the EBITDA. And there's two ways to do that mainly. Increasing the revenue, driving revenue growth somehow, or cost cutting, right? So, and what's the third way? Cash paydown. You guys should know it like this. Cash debt paydown, right? The cash in the business being spent to pay down the debt. So even just looking at the core financials historically, you can tell there's not much growth here. LTM growth is 0.4%. 2012 growth is pretty high, but when looking at the next year that comes out and the analyst research, which we will do to make projections, they're projecting anywhere between 0.1, 0.5, and upwards of 0.7% growth. Nothing more than that. Not adequate revenue growth to show 25% returns, right? When looking at the cash flow, the total change in cash here is negative. And when we project it, we're projecting it a little bit more aggressively, it'll be positive. So I don't know where they're getting the cash to pay down the debt. So the cash debt pay down strategy is negative. The multiple expansion strategy is negative. So when we build the model, we'll realize, like we did in the mini analysis, that the returns are quite low. So how are they going to maximize returns? The only other strategy, if cash is negative, if we don't see multiple expansion, is improving EBITDA. And if growth is not huge in the beginning, it's got to be cost cutting for them to at least repeat immediate returns. Now I mentioned, which is interesting, is there was a press conference, right? There was a press conference where, despite this quick analysis, they didn't really comment on the idea that cost cutting was a possibility, because that would kind of probably freak out the employees and the shareholders and things like that. And when concluding the book and concluding that really the only way to reach profitability is by cost cutting or some really aggressive, revenue strategy, which I didn't think that they were going to get to, although they did end up getting to craft. But I mean, this is now a year, 2 years later. We had realized, after I printed the book and after the deal was closed, we showed articles coming out about a lot of cost cutting, right? I don't know where I went. Well, for a second, I found the press conference on YouTube. So let's pull it up. Let's see if I have it. And I want you to make your own conclusions. So, just to recap and just to clarify, so this is what I had found after I printed the book. We did the analysis together in class, and we all kind of concluded the only way to achieve positive returns, and we'll do this, is if you reduce SG&A somehow. And so despite the fact that I had thought that, or we had thought that in the press conference, they kind of deflected that theory, this came out, right, Heinz, and then there's some subsequent articles, right? This was now in August. So the announcement was in February, takes about 6 months to close. This is pretty much immediately after closing. And so I wanted to reference this by going back to the press conference, but they took it down from the Heinz website. So let's watch a little bit of it. There it is. I'm so glad it came up again. I guess it was posted 2 years ago, so maybe it was up there. I just didn't take to search for it this way. I'm not going to watch. It's 25 minutes. I'm not going to do the whole thing. I want to jump to a few points.
Welcome, and thank you for being here today. It's a truly historic moment. The H.J. Heinz Company, our shareholders are 32,000 employees around the world. Our customers are global consumers in the great city of Pittsburgh, where the Heinz brand was first born. Heinz has entered into a definitive agreement to be acquired by an investment group led by Berkshire Hathaway and 3G Capital, two names with stellar reputations doing the right thing for and with the businesses they own. Doing the right thing has been a credo of the H.J. Heinz Company since Henry J. Heinz introduced his first product in 1869. And that simple premise that served us so well for all of these years has led to today's exciting announcement about a new partnership and a new platform for growing our great company.
Okay, you get it. You get it. Let me jump to the question and answer portion of it. So he talks. You can see the little. Then they introduce this gentleman who's the principal at 3G that did the deal. Everyone's excited. They shake hands, and then questions. But let's go to some of the questions. These question and answering mode.
3G is associated with some aggressive cost cutting measures in the past. Is that a strategy like this here? And if so, what are the significant costs?
Get right to the point.
I think that we've been, involved in a variety of deals in the past. Some of them had a lot of cost optimization opportunities and efficiency, and some of them didn't. And I think here it's very early to say. I think we're just getting involved and have several months ahead of us to get to understand the team and the people. And this certainly is a company that, if you were to compare and contrast with some of the businesses that we got involved with in the past, this is a company that's doing extremely well as it is and has been doing extremely well for a number of years prior to going involved.
So I don't know how you interpret that, but to me that was kind of dancing around it. And it's a complete dodge, and even without making projections, this is not extremely well, right? A company that has negative $1 billion in cash flow in an LBO strategy. So, I mean, you can read it as you will, but after even laying out the hard-coded financials and them saying they don't know what the strategy is going to be, knowing even what we know after a couple of weeks seems a little unusual. And then they bring it up again. So I believe it was, let's go a little forward. There's concerns about the headquarters, it moving, and they said that it won't move.
Just to follow up on that question, you mentioned that this kind of detailed note is expecting out of Pittsburgh. What changes down the road will you see now once this merger is in place?
Well, I think initially you won't see any change. I mean, I think Pittsburgh has been Heinz's home since 1869, and we will continue to honor our commitments in Pittsburgh. You'll still see Heinz Field. You'll still see Heinz Chapel. You'll still see Heinz involved with a number of things. I think over time, to further your question, I think over time what you'll see is hopefully a growing platform for substantial global growth. And I think one of the things that interested 3G and Mr. Buffett in moving into Heinz was the ability to use this as a platform to sort of get bigger around the global food industry. And Pittsburgh obviously being our headquarters, that would benefit Pittsburgh over a period of time. But I think initially, and I probably think even a year from now, you won't see anything that really will change your view of Pittsburgh. We will simply not be listed in the papers every day and in the stock table. But we will continue to be here and continue to be very much involved in the community.
Will there change the number of jobs tested?
I think it's too early to say, and as Alex said earlier, we have not had those discussions yet. But long term, it could go the other way. Long term, we may have more jobs here as the business gets bigger. So, again, I think the thing you all have to keep in mind that makes this different than most situations is this company is being acquired from a position of strength. I mean, our stock's been at an all-time high. We've had 30 consecutive quarters of organic top-line growth. I mean, this company's never been stronger. That doesn't mean there won't be changes going forward, but I think ultimately this will be a platform for really doing bigger and better things in this industry. It is interesting, as an aside, that if you look at the market today, a number of our peer companies are trading up on the news about us. And I will leave that implications of that to your own judgment and discretion. But I do think that our goal here is to make this a bigger, even more global company. And I think that's a goal we share with 3G and with Mr. Buffett.
So interesting that, right, about a month after they closed the deal, and it was more than 600 jobs. I think what was the status of, was it up to 3,000, 4,000 jobs were cut. He left his post immediately upon closing of the merger. So obviously, although it being maybe a platform for global growth could be a strategy because of the merger with Kraft, I don't know if that was the initial strategy, but they're clearly, I mean, I don't know, you can take your response. It's really interesting. And it's interesting to see how they position it, and it's interesting that this came back up. So I wanted you to kind of get firsthand, I mean, what are your thoughts on that?
Shareholders got to get values.
They did. So he was right about that. I mean, there's some things he was right about, and I'm not, but interesting how there is one clear strategy of profitability initially, and they kind of danced around that. I don't know. Maybe they didn't. They did. But so blatantly, which is what I was surprised about. So blatantly danced around. Not even said, oh, there might be some.
I'm surprised no one hammered on it that it was so good.
They asked it twice. I don't know. I don't know why they didn't. It was very strange.
They're probably didn't know how to balance sheet.
Say it again?
They probably didn't know how to read a balance sheet.
I don't know. I mean, there's definitely people that know. The analysts. I mean,
Yeah, everyone who's there before, they don't do this.
The business reports, though,
business reporters come from the banking world. They know the stuff. I don't know. Maybe they wanted the surprise news.
So did he resign, or did the CEO resign?
As probably part of the strategy. So that's what they did with Burger King. They turned over the CEO. They got a new CEO that knows how to manage more efficiently. And he gets to access all his options and gets his exit, things like that. So there's incentives in the right place. But it's interesting to see it firsthand. So hopefully the point is that you have a little bit of a goal in mind when putting this together. And even just, again, 3 strategies to any leverage buyout is EBITDA growth, positive, steady, predictable cash to pay down the debt, and multiple expansion. When they're paying a 14.4 times multiple for this, and in an industry environment that's declining, the multiple expansion is not there, right? When the cash is negative, we're going to find ways. We're going to model it so that the cash is going to be positive because we're going to do things to make cash positive just by wiping out non-occurring items. So cash will be positive, but not significant enough to pay down the $15.5 billion of debt that they've raised within enough time to turn a profit. EBITDA growth would be there if they do some aggressive revenue growth strategy, but the history is saying it's not growing. So when they say this is a position of strength, not at 0.4% growth, right, at this very position when analysts are not predicting any further growth and they're spending $1 billion in cash, doesn't sound like a position of strength to me. So the only way to turn this into something profitable is by reducing the costs to get EBITDA high, right? Now, they also ended up finding this as a platform, right, and maybe they'll continue to do that. But they clearly were direct about the fact that they're going to have to reduce costs to make this profitable. And even before building the LBO model, you can see that. So that's just kind of the point we're trying to make. All right, so let's continue with this. So we had laid out the sources, assumptions, and now we have to lay out the uses. So now, just the way I put together the book, I want to follow with that, and at that point, the book has you put in the hard codes. I don't want you to put in the hard codes. We have the hard codes there, but if you didn't have the hard codes yet, I made a quick assumption for the net debt, and the quick assumption that I had made is based upon the press release. So the press release that was announced was that they said Heinz shareholders will receive $7.50 per share, and they said that the transaction is going to be valued at $28 billion, including the assumption of Heinz outstanding debt. So the way I took that was that the difference between the $28 billion and the $23,575 was the debt. There's $23,575, $28 billion if you include the debt. So for now, I said, let me just do a first cut assumption. Let me back into the net debt by taking $28 billion minus $23,575. And over time, as I lay in the hard codes, you get a better understanding of what the net debt is. I'll link that in. That's the way I did it. So just a lesson on interpreting, reading between the lines. So we have the purchase price here. The net debt, I'm going to, for now, I'm going to highlight it yellow, knowing that this is going to change. $28 billion minus the purchase price. 4,424. And we'll see, the net debt actually came down to be like 3.8. It wasn't too far from it. So that was a good way to do a first cut assumption. Let's do it now so we can follow how we did it in the book. And I also then plugged transaction fees. Knowing that the total sources was 28,840, then that remaining 840 was transaction fees. The way I did transaction fees for now, I did 28,840 minus the purchase price minus the debt. Anything left over. Because we know the one given was how much in total capital is going to be raised for now. 840. Now I'm going to look at the fee as a percentage of the purchase price, 3.6%, and I'm going to total up the uses so that the uses match the sources. We can prove that, and that's how I laid out the uses.
What would get transaction fee?
We took the total sources minus the purchase price minus the net debt. Yeah. And a couple things here. Percent of total capital. This is just to kind of get a feel for the equity that's put into the business, or the percentage of each asset class as total capital, how much is being raised in debt, how much is being raised in equity. So I'm going to take the revolving line of credit and divide it by the total capital. I'm going to anchor the total capital so that I can copy this down. Make sure you're getting that. And so what's interesting here is this is another question, right? In the beginning, somewhere in the press release, I'm sorry, in the press conference, They said, well, is this a private equity deal? And the argument against it was no, because they're not raising enough debt for it to be considered significant. Notice here that the debt is 44%, which that's a true argument, although I think there's other supporting evidence there that clearly makes it a private equity deal, and in the end it was a private equity deal. First being that an aggressive private equity investor is involved in it. But also what they didn't mention is this preferred is actually acting like a debt. And usually in modeling, we would assume some percentage of preferred, either an 80-20 rule or 60-40 rule to debt. And that, if you include the preferred as debt, then that's 71%, right? The straight equity is 28%. So it really all depends on how you treat the preferred security. Technically, though, by contract, it's listed as equity. So this is where, preferred is a hybrid, it's a convertible. Equity ownership, usually you just divide by the percentage of equity invested in the business. These guys had a special arrangement. It wasn't formal what the arrangement was in terms of it wasn't publicized. I read in an article that somebody said that it was going to be a 70-30 deal where 3G would get 70%, Berkshire Hathaway would get 30, so I hard-coded it in that way. It'll be blue, we'll use it as a sensitivity. It definitely wasn't 50-50. You'll see if it was 50-50, then somebody's going to have a negative return. The idea for 3G having more of a percentage is because Warren Buffett is seen as just a financier in this situation from his perspective. He's putting money in. He's getting a preferred that's acting like debt. And 3G is they're really responsible for managing the business and managing the EBITDA and managing the cost cutting and managing the revenue growth. So they're getting a larger piece of the pie for that risk. That's really the way, I believe that's the way they thought about it. The terms of his preferred is he's going to get an 8% dividend each year. So we'll model that out. So that's basically the layout for the sources and uses. And then we have purchase multiples. So I talked about the purchase multiples. Let's lay out what the purchase multiples are now that we have hard codes. The enterprise value is the purchase price paid plus the net debt assumed. So that's 28 billion. The 28 billion we backed into. What is that divided by the LTM EBITDA and the LTM EBIT? Well, the enterprise value divided by LTM EBITDA, 1908.9, 14.7. I said 14.4. That's going to change when the net debt changes. It ends up being 14.4. LTM EBIT, enterprise value, 1561.3, 17.9. This is accounting for the slowdown. Okay, any questions on this so far? So this is step 1 and 2. So we know the purchase price was given. We have the sources help us lay out the sources. The uses we backed into for now. We're going to have this net debt evolve. Transaction fees are basically going to be a plug right now. Right? We can't have the transaction fees lower than building to this 28,840. 28,840 is the only constant. Now notice a few conservative things here. If you remember that they said that the term facility said 10.5 along with a 1.5 revolver. I wasn't sure if the 1.5 revolver was part of the 10.5 or did it along with mean 10.5 plus 1.5. That wasn't clear. So I kept it at 10.5. If the 1.5 was part of that, I would have lowered that 10.5 down to 1.5 to 9. Also, they said that the notes, they said up to 2.1 billion. So my guess is that 2.1 billion, if they don't have to take as much and spend as much interest on that or fees on that, they would lower that 2.1. And I think in the end, they ended up lowering it to about 1.75. So that would change the landscape. But I wanted to, but this is at the end, I wanted to model this as if we were actually in February. This is all we had right at the time. And we'll, if you want to, at the end of the returns, we'll lower that to 9. We'll lower that. It's not going to change the returns that much. It really doesn't have much of an impact. Knowing how low the returns are, and there are other things that have a more massive impact like reducing the costs. We'll learn that as we model it out with the how massive those adjustments will become. So now we go to the financials. I do want to lay out the financials a little bit, and I do want to have us look at the financials so we're not just like pulling this off as if it was a template. I want you to understand the financials that we're pulling from. So here's the annual report. And so, you know, we saved you time in hard coding it in for you. I don't think it makes sense for us to sit here hard coding together. But let me just show you what we had given and adjustments that we made, if any. The good thing about these big companies is the financials are usually quite simple, less convoluted, subject for further research if necessary. Here we go. Here's the income statement. They got sales, cost of product sold, easy, cost of goods sold, SG&A, easy, interest income, interest expense, broken out for us. Right? So everything was just laid out kind of verbatim there. Other income and other expenses. Were all basically laid out as is. Right? So this is the way we laid it out. We laid out the revenue as stated, cost of goods sold, OPEX, SG&A. I added 2 rows here that you should do in every LBO. One is a fund management fee. Now, I kept it at 0 for now for 3G, but in smaller companies, it's more of an impact. So if you're buying a business and managing the operations of the business, you will charge yourself a fee for doing that. That's just one way that a firm makes money. I don't know how much 3G is going to charge themselves. Well, if it's several million, it's nothing compared to the billions of dollars of cost of goods sold. So I left it 0 for now. I know they're going to charge themselves something. And then cost savings. So cost savings is going to be obviously a big factor of this model. So we're going to lay out cost savings as a sensitivity. Then we got to EBITDA, and then we had depreciation. So going back to, and whatever, I tried to, I guess, close it. Okay, going back here, they did not lay out depreciation explicitly. So again, we had to do a search for depreciation. And one thing I knew about Heinz, and I saw it in a couple of different areas, was, namely the cash flow statement, they clearly separated depreciation and amortization. They had a big, for their brands, they had a big amortization line item. So I didn't combine it. I kept it separate. So for you guys, if you're seeing it separate, it probably makes more sense to keep it separate. Because while depreciation is based on the straight lining of assets or acceleration of assets, amortization usually is done a totally different way. So if you can separate that, I would separate it. This is automatically separate. Right? Amortization doesn't stack with CapEx like depreciation, right, like PPD does. That's an important point. So I kept that separate. Here's a line for the amortization of identifiable intangible assets, if any are found, and we'll talk about that. It gave us EBIT. We had interest expense and interest income. I kept interest income as positive and subtracted the 2. The other alternative is to show income as a negative. Income tax expense here. So one thing that I've done back in the income statement, just so you're familiar with the financials, there is this line item, other expense. I had realized this, or thought of this as extraordinary. The specifics were other expense net. I had researched the specifics. I don't recall. Okay. Yeah. So this isn't the exact note. It's in the book, but these are adjustments based on hedging, derivative instruments and stuff, which usually should be other comprehensive income. I don't know how they got away with putting it in income, but those accountants know more than me on that specific. But that's clearly extraordinary, not core to the operations, so I pulled it down to extraordinary items. When you pull something from above the net income line to underneath the net income line, you have to pull out the taxes associated with it. You cannot keep the tax deductions. So what I did was, for taxes, I did not hard code the taxes. I backed into what the implied tax rate was and then recalculate the taxes like you should do with the comps. So where's my income statement again? Okay. So whereas the EBT is 2012 is 191.7, the EBT here is 1183.4. It's a little bit higher. It's a little bit lower because there was an expense in there that we ended up pulling out. No, it's higher because that expense is actually income. So we can't use 243,535 in there. Those taxes would change if that income was pulled out. So what I did was I backed into what the implied tax rate was by taking 243,535 and dividing it by the 1183443. So it's a technique you should know. So in the cell here, I said, well, take 243,535 divided by 1183443. What was their implied tax rate? That gave them an implied tax rate of 20.6. That's a hard code. And I backed into, all right, well, we have a different EBT number, so using that same rate, what would be our implied taxes that we would get? It's 245.2. So that gave me 946.4. Here was that expense that I pulled down, and when you pull it down now, you have to take the actual number and multiply by 1 minus the tax rate to show the after-tax effect of it. That's the only way to get to a net income after non-occurring events that still matches exactly what they have. 939,908, 939,908. Otherwise, you won't get a number that matches. They have net income attributable to non-controlling interests. I keep it in there until we realize and research if that non-controlling interest holder will be negotiated above and beyond the regular, right? This guy was negotiated separately. Getting us to an EPS that should match 2879, 287, 2855, 285. I just went out to 3. Got it? That's the income statement. Any questions? So I wanted to start projecting out a lot of this information, and we'll do sensitivities. I'll show you how to do the sensitivity analysis. We'll do a scenarios tab. We'll run some scenarios with the Dropbox, a little bit more user-friendly. But the first thing to analyze is what's the revenue growth. Now, we talked about with Walmart how to go to Yahoo Finance, at least as his first cut. I don't recommend that as the be-all, end-all. It's good to get equity research. And you really want to, in order to determine revenue growth, there are a few resources you want to get to. You want to see what the Wall Street analysts are saying about the business. You want to go look at investor presentations where they have management projections. You want to go to third quarter releases with the management discussion analysis where they sometimes talk about where they expect their performance to be and to go. You want to go to all these resources. The first, take a look at this resource is Yahoo Finance, is their analyst recommendations section. So I won't show it again. And I can't show it for Heinz because they're not private. That's why I want to go to the book. But at the time before they became private, I pulled up what the analyst estimates were. And so on page on page 120, they show what the analyst estimates were. You guys, you don't mind? I guess you can't. It's not even worth it. Not even worth holding it up. And they suggested for 2013, on average, 0.7% sales growth. Okay, so that's the average. So now it's important to see the high and the low. So the average estimate was 11.73 billion. And as the average, the high was 11.87, the low was 11.56. Let's see what percentages get to the high and low. Now, one thing that's important to understand is timing here. They're on a time frame that ends in March, right? We did 9 months to get out to January 27th because that was close to the acquisition date, right? Once an LBO happens and the company goes private, usually the fiscal year end changes to acquisition time or closing time. So 2014 is no longer, I forgot the actual, was it March or April? April 2014, April 2015. It's going to be now January 27th, 2014. 1 year out from the LTM. Remember the LBO perspective. The LBO perspective is LTM, we're assuming that they're going to buy the business right now, and 2014 is 12 months from LTM. We're going to project that 12 months out directly from LTM. So you got to understand the timing. So it's a little bit off. So when the street says 2013, they're going to expect 0.7%, that's a little bit different than what we're projecting, which is 12 months from LTM, but at least it gives us a proxy as to where the street thinks the revenue is going. And they're pretty much on target because already 9 months into the year, they're at 0.4%. So the question is, do we be conservative? Do we be aggressive? What I want to do is I want to find a median and then run 3 scenarios, a conservative case, the aggressive case, the maximum and minimum boundaries, and see what those maximum and minimum boundaries mean for interpreting this into IRR. That's the real important thing, right? What's the incentive to the investors? What's their IRR? If we have a minimum, what's the base IRR? Where could it go? If they do hit the maximum, where could their potential IRR be? So in the beginning, let's take, just for now, 0.4%, because that's what it was last year. And I just want to see what that means in comparison to the average. So 0.4% related to the year before times 1 plus the 0.4% gives us 11.738.3. Right? So the street had suggested in 2013 11.73. So this is exactly the average. So let's keep that for now, and that's pretty good. If we had used their 0.7, that would have gotten us to 11.773. We could have done that. And they had a maximum estimate of 11.87, which seems like it was about like a 1%, maybe 0.8%. For now, let's keep 0.4%, and we'll plug this into scenarios later to show what the maximum and minimum could be. Well, I guess I showed, did I say 6.5%? Is that true? 12.45? Okay, yeah, I said, right, I'm looking at so I was looking at 2013. In 2014, the year later, 2014, I matched up with 2014. I was talking about they showed a maximum of 12.49 billion, which is 6.5%. And a minimum of 11.81, which is the 0.7%. 0.7%. So if we're looking at 2014, the street was all over the place. If we look at even 1 year later, 2014, the low was 11.81, which was their 0.7%. I don't know why this is freezing all the time. 0.7%. There's their 11.8, and then a high of 12.49. So you can see the analysts were divided. So we'll use that in our sensitivities. We'll do their high and then their low. We'll use our average and the approximate management projections, and we'll see what all this means for the potential returns. For now, we'll use 0.4, and we'll copy everything to the right. I don't know why this is doing this. For the costs, what I always do as a first cut is take the year before's percentage. Right? So my recommendation is this. Use the analyst high and low revenue estimates. Take the costs to be the same costs as the year before. See what that means for earnings per share. If the earnings per share matches the analyst estimates, then we're in an appropriate range for now. And then you do further due diligence later, which is a first cut analyst. If we're using the same revenue growth as the street, but the EPS, our EPS is much higher, much lower, that means that the street is projecting some cost-cutting initiative or cost raising initiative that we didn't bake into our model. That's the greatest, first, easiest way to back into what the street's doing, the street estimates. You get that so far? So if we're using the same revenue growth as the street, same expenses as the year before, and we're off by the street, then the street's estimating some adjustment to costs that we didn't estimate. So first cut is to use the same, 61.6% of revenue. Let's multiply that by the revenue. This is doing this every cell that I type in. Right, every percentage of revenue, copy this to the right, and we'll continue to build down. So why don't you, let me try to tweak a few things with the settings here, but why don't you try to build down to EBITDA, match the EBITDA numbers, take a few minutes. Let me pause this and try to play with the settings here, see what's going on. Hard code the management fee at 0 for now. So that didn't help. I can't build a model like this. So for cost savings, we could have added 0, but just as a starting point, I assumed 1% of EBITDA. It's going to be greater than that. So 1%, multiply that by the, not 1% of EBITDA, 1% of SG&A. Multiply that by the SG&A. I'm going to put it as a negative because it's a negative. It's a reduction to the costs. And then what's built to EBITDA, let me know what you get. So depreciation, amortization of identifiable intangible assets, we'll leave out for now, as we always do. They'll come from supporting schedules, but we can still copy over the total depreciation amortization and continue to build EBIT, which you just continue to copy to the right. Same goes for interest expense, interest income. Copy to the right. You guys have that? Taxes were a little bit different. You know, I saw the 17.3. These were quarterlies, so I didn't really think too much about those. I noticed that the tax rates were slightly declining. I was afraid of being too conservative with 17.3, so I did a little bit more research into the taxes. And when doing a word search on tax rate, I actually found a write-up on it. So, you know, when in doubt, always here it is. This is, so they actually explained how they get to such a low rate from the actual, you know, federal tax rate of 35%. And so what I tried to do was I tried to pull out things that were extraordinary. So tax on income of foreign subsidiaries will stay, right? So they're going to be at least around 27, 28%, right? Changes in valuation allowances seemed extraordinary, right? Valuations change, and this is kind of a one-time, this big hit here, small hits here. Earnings, reputation will stay. That's ongoing. Tax-free interest will probably stay. Reevaluation of tax-based foreign assets might be extraordinary. So I did an analysis and I got around somewhere around 25 to 28%, kind of playing around with tweaking this. Still wasn't sure where to go there, and I wanted to be conservative. So definitely 35% was probably too conservative in my mind, because a big portion of the business is international. And so I thought about the 7 methods, and what I ended up doing was I noticed that I was thinking about anywhere between 25 and 28%. 27.8 was the maximum that's ever gotten to, so 28% is probably too high. So for now, I thought it was appropriate to at least take the maximum of the last 3 years, which is 27.8%. At the end, we can go back and say, well, what if it was 35%? What if it was 17%? How much of an impact would it have on that valuation? And we will soon find it doesn't have the biggest impact. So part of the case study part of this, which you might see in interviews, is not only giving an expected IRR, but what are the major variables? How, as an analyst, do you know to zero in on the variables that matter? So we're going to learn a lot of that as we're building up this case. And going back to, remember what we did on the board where we listed out all the 14 different areas of variables, we're going to do that again when we get to the end of this case and say, which are the ones that matter? Which are the ones that were a mystery, like a tax rate, and slowly narrow down and cross off to the ones that matter. And that's the way you would do it when handling an actual case. So 27.8, I'm going to highlight this red. This is a variable that matters. Same thing with SG&A. And I'm going to multiply this by the EBT. Extraordinary items, I kept 0. Most of it. The other expense, I continued at 19.1. I assume that was more conservative than making it 0. It's not going to go into our analysis, because our analysis, we're going to take this higher net income anyway. So don't be too concerned about it. But I did realize it was, even though it wasn't pertaining to operations, and that's why I pulled it out, I did acknowledge the fact that it was ongoing. And the 19.1, the last 12 months, was the largest of the expenses. So I kept that. The loss from discontinued operations was clearly one time. So I kept that one 0. And these other ones just didn't exist for 0. And that was my thought on it. If you had made that 0, it probably wouldn't affect it all that much. No, it's not going to go into the cash statement anyway. So I'm going to make all that 0. And that's our net income after non-occurring events. When we stop there, okay, company's private. We'll deal with the minority interests later. No shares, right? It's all wiped out. So again, this number is going to change as we get depreciation in there, as we get interest expense, interest income in there. The next process from here is to pull this into the cash flow statement, build out the cash flow statement as much as we can. We're not going to be able to build out the depreciation section, deferred tax section, the working capital section, the short-term debt, the debts section. We'll lay out as much as we can. And then the next stage is to be able to fill out the depreciation and working capital, but we can't do that without balance sheet items. So we're going to have to lay out our balance sheet, lay out our balance sheet adjustments, think about the goodwill, think about the intangible assets, find out what the net debt is, pull that back into our assumptions. We're going to have to do all of that. Once we lay out balance sheet adjustments, then we can build depreciation, working capital, link it back to the cash flow. Cash flow will drive the balance sheet, do the debt schedule, and then we got to go into layering in, the returns, preferred dividends, paid-in-kind securities, all the other stuff that's specific to the leverage buyout in the case, and getting the returns to 3G and the returns to Berkshire Hathaway, two separate returns analysis. And we got to lay out scenarios. Any questions on this? Okay, we'll stop here, take a break, and then we'll do some interview prep questions.